Hello, I'm Robert and welcome to my channel where I talk about everything automated algorithmic trading or simply algo trading. If you followed my channel for a while, then you know I try to put up daily shorts on where I think the market is and what it's going to do. In this video, I'm going to do something a little different, and I'm going to talk about the longer term prospects of where I think the market is going, and techniques I use as I figure out or try to figure out what I think is going to happen. So let's get straight into the chart. I'm using Range Hunter from Jackrabbit TV to help me evaluate the process. Now I use 2 to 3 different techniques on a regular basis when I work with trading an instrument, as I don't like stop loss in general, and I'm not always using just a pure accumulation technique. So the third approach I use is a hedging technique, where I will trade a pair that is inversely correlated to my primary pair. In this case, my primary pair is EURUSD on this chart, and my inverse correlated pair is USD Canadian dollar. So I trade these two against each other as part of my risk mitigation technique. So let's get into the details of EURUSD. As we can see, it is on the rebound of a rather significant down drop, which is the lowest in its most recent history. This is important because you'll notice the bear market from the COVID pandemic was quite extreme and strong. The recovery process is going to be equally as long, I believe. Now, from the standpoint of the median, this is where I believe price is going to return to. Think of the market as like a giant rubber band. Price wants to cycle up and down, from the lowest point back to the median, and from the highest point back to the median. The median is where price wants to stay at most often. And these two 10% boundaries, or basically a 20% range, is what would be considered a normal calm cycle. And we can see historically that this is held true. When price leaves and goes up above the median, it wants to return to the median range. When price goes below the median, it wants to return to the median range. It doesn't necessarily have to cross the median, but it will want to return to this range. This is the midpoint by which the bulls and the bears neutralize their activity. That is, when price gets too high, the bulls pull it down, or the bears pull it down. When price gets too low, the bulls drive it up. So this is the battleground between the bulls and the bears as they fight over which way the price is going to go, or the hot spot in the battle, if you want to call it that, where you can see the most whipsaw and the most aggressive volatility as they really push to one side or the other, trying to control the market. And when you have the situation like this, or like this is when one side or the other will break out of the controlled normal cycle and seize the market aggressively. So what we see here in the long-term scope of trading for EURUSD is that price is slowly moving upward towards the median. I think that's going to continue. I think it's going to continue pretty much the same way this cycle here continued until it reached a relatively median point that the bulls and the bears began to aggressively play their tug-of-war games. Now, if we go back historically, We will see this process play out over and over as the market swings above and below the median, where it will respect the median in terms of its cyclic approach. This is absolutely critical in understanding where price is going to move. You need to really think about your strategy in the context of the median value and how that median value will or won't affect trade direction as a whole. So we've already gone all the way back to 2015 on this chart. So as we continue to look at where the market is going and it continues to move towards the median, the closer it gets to the median, the more volatility you could expect in a whipsaw nature. The further away it gets from the median, the more volatility you could expect in the direction of the median. Now this particular chart breaks the bands up into 10% movements, from the highest high of the price to the lowest low of the price, to ensure that the historical representation is taken into account in such a way that you get an accurate data point to examine. Now, the thing that is critical in this whole process is understanding that as your market moves, so will your risks, which is why I am using USD Canadian dollar as a hedge. For grid trading, which is my preferred method when I'm not using accumulation, you're looking at a huge price jump, and the grid levels to maintain this are going to be nightmarish, to be quite honest. So you can't just say, I want a grid of 1,000 levels. Your broker's not going to accept that, and realistically, trying to maintain that over the long term is going to be extremely difficult. You need to have an explicit floating grid technique like what I use to mitigate how many grid positions you have and to control your risks in the process. The more grid positions you have, the more your exposure. And if you're on an exchange that is margin and leveraged based, as OANDA is, you're going to pay a finance fee. And that finance fee for your margin can get quite steep the longer you hold dormant positions. So realistically, I want to keep that process at a minimum as much as possible. So hedging with USD Canadian dollar gives me a way to inversely correlate. As the Euro USD is dropping, USD dollar is going to increase in price, or USD Canadian is going to increase in price. So I can swing both directions within the same account so that as one is accumulating, the other side is selling off with profitability. Now the trick to this is making sure that you trade both assets in the same direction. In my case, I am shorting both Euro USD and USD Canadian. So by doing this, I'm getting that effect of moving the market in either way and making profits appropriate to my preferred direction. So as we let this process unfold, we are able to make profits consistently in both directions while mitigating our risk and not letting our grid grow out of control. The last thing you want is to have a runaway grid on a price point spread as steep as this. This could wipe your account out if you try to cover this whole radius in a way that is going to give you reasonable profitability. And that is such as 100 different trades, which you could do if your budget is large enough. But it's not realistic with respect to the finance charges you're going to pay in the long term to maintain this type of a trading approach. So, as we see the way the market is shifting, my thinking process is to really look for opportunities where I can use the elasticity of the market in my favor to pull it towards the median. And that's going to be the most critical point of my own trading approach when I place any manual trades. This way I can see from where the market is to where it isn't. And by looking at the forecasting of the range hunter technique, I can see that the 1 hour, 4 hour, monthly, and daily are all swinging upwards. And with respect to its counterpart, USD Canadian, I can see it's beginning to swing downwards. So let's move into the closer look of the chart, where the actual bot is going to be functioning, which ranges from 2 seconds to 15 seconds. Looking at the 30-minute chart of only Euro USD, we can see that we are respecting our normal cyclic pattern. We're within the median range on the short term 30-minute, and we can see this back and forth play between the upper and lower boundaries as the bulls and the bears figure out which way to try to push the market. That is, as they engage in their tug of war trying to take control of it to a breakout state. Now here, because the time frame is so small, most of the moving averages aren't really that important. So we're just going to focus on the price action itself. And through that process, looking at how these cycles take place, because that really is the importance of the market structure. We can see here, as the market dipped below the median, at this point is a slow progressive state, but then began pushing itself back up towards the median through the elasticity of the market. And we see here where the bulls pulled it quite close and aggressive to the median. But you can see here where the bears used a slow, steady approach to pull it aggressively down away from the median. So this is why I believe very firmly that the price in the longer term is going to return towards the median, and why really you should be looking at long-term positions if you're not using a hedging technique. You're going to be more likely to benefit from the long-term trading than you are the short-term trading at the more in-depth levels. So let's continue moving down to different time frames and see just how the market looks at those intervals. And we can see here on the 5-minute that the price is pretty close to the median, so the bulls and the bears are simply aggressively going through their tug of war, trying to push that breakout state. And you can really see just how significant the dynamic is between the bulls and the bears with respect to the median. Now let's turn off the forecaster and actually look at the price itself. Ideally, you can see where you have good entry points and good exit points if you're long-term trading with something that is not grid-based. An accumulation approach would do exceptionally well here, as you could very easily get into a situation where you can make quite a few profits. Jackrabbit TV would make very nice work of this over the long term, but still be able to mitigate and limit your risks. So let's go even further down and see just how price respects the median. Let's go to the 1-minute. And you can see even at the 1-minute, price respects the median. So as you think about your trading for the next week, the next 2 weeks, the next month, really focus on the fact that we are going to be pushing towards the long-term median of the trade. This price will eventually get within this median zone, unless a specific and unpredicted news event happens. But I don't see that happening in the long term when you look at how price has been flowing and respected in the past. Now, given that past performance never equals future performance, you still know statistically by looking throughout various historical components that you have a probability of being able to actually calculate how often this occurs. And you can see it over and over as a consistency within the market. So, we can safely say that we can expect with reasonable assurance that price is going to respect this pattern and move back towards the median of the market. So really, if you wanted to just say set up one position, set up a long with your take profit eventually at the median, and you should, reasonably speaking, be able to get there. And you're looking at a 20% profit between these two bands, since each band represents 10% of the entirety of the range. So this could bring you a 20% profit on one trade. I prefer aggregation though, which is why I prefer the smaller time frames to be able to get a back and forth swipe within the time frames. The daily time frame doesn't provide enough trades for me to realistically be able to make it profitable for what I need to pay for my VPS, my subscriptions, and my other services I need to analyze the market. So focus on what is appropriate for your trading in terms of your break-even point on the basis of what you actually spend to get your profitability, but keep in mind the long-term focus of reaching that median. Now you can apply these techniques to any market. It really doesn't matter because every market technically respects all of this process. For example, let's go to the Euro GBP. And looking at this market, we can see it is above the median, so in the long term, we expect the price to return to the median. So that's it for this video. If you like this kind of analysis and detailed information, hit that subscribe button and please like the video. Help me with the YouTube algorithm. And remember, if you're looking at where to go for the market, look at the long-term median, and EURUSD is going to go towards that median. So expect a long positional trade if you're not using grid trading or accumulation. Specifically a specialized version of accumulation. Because if you're looking for rapid profits, focus on the median. That is the critical point. Thank you for watching, and until next time.